Hello friends. Last week in my video, we discussed whether the bulls were finally back in the saddle or this was just a pullback rally. I told you that in my humble opinion, the market was still in a pullback rally phase and not a complete trend reversal. Are we far better off as compared to what we were a week ago? We'll delve into that in this video this week. Let's jump right in, and on your screen right now is the market roundup window, which tells us that the rally was powered by the broader based Nifty 50 and the Bank Nifty brought up the rear. The US dollar index continued its downward trajectory, which was bullish for commodities, and apart from natural gas, which I have been posting on my free Telegram channel, that it will diverge from the trends in crude oil. Apart from natural gas, everything else in the commodity space, whether it's gold, it's silver, or crude oil, went up. The USD INR, that is the dollar versus the Indian rupee, also eased, and that also helped the bulls because imported inflation comes down when the rupee is stronger. The 10-year benchmark bond yield fell by 9 basis points because the RBI in its interest rate announcement kept the rates on hold, and that more or less provided a relief rally to bond prices, which again resulted in a mark-to-market profit for banks on their bond portfolios, and the banking segment got a boost. NSE gained 1.65% in market capitalization. This is the third week in a row that you've seen the capitalization go up. So the bulls still had an upper hand. MWPL rose by 3.09%. That was along expected lines after an expiry. The US markets provided tailwinds barring the technology sector, which was a drag. Coming to our in-house indicators, what we are seeing is MWPL continues to remain sluggish. Do note, after the expiry of the March series, the low reach was 20.85, which is the lowest in the last 20 weeks. Even pre-expiry peak of 29.81 is the lowest in the period. So risk appetite still remains poor. In the week after expiry, what we are seeing is the MWPL is at 23.95, which happens to be the lowest in the 4 previous monthly expiries that are on record in this picture. If the bulls are really serious about a rally, then they should have expanded their footprint and the MWPL should have been clearly significantly higher. So this is one minor thing to note. Now let's see the stock and index futures turnover. This is the cumulative April, May and June series turnover, and this is for 3 trading sessions because the previous week was short due to 2 holidays. So the turnover was expectedly lower, but we need to watch this even more carefully because of late, day-on-day turnover is also down. This is week on week. Now for the advanced decline ratio, what you are seeing is the NSE gained only 1.38% as compared to 2.45% in the prior week. But the advanced decline ratio, now remember this is an average of 3 trading sessions, went up to 1.67. That means for every 100 shares falling, there were 167 shares rising. This shows that risk appetite in the one Marshmallow traders. The Marshmallow theory is explained in the description below this video as well as in the pinned comment below. So the one Marshmallow traders showed somewhat increased risk appetite. Now that is a positive. Now for the basis. Basis is the premium or discount prevalent in futures compared to the cash market. Basis fell. Now this is something that I had put up on my social media accounts, that this kind of basis that we saw after expiry was unsustainable. And sure enough, the basis has more or less halved, come down by 50% almost on both the indices. What we do need to watch out for is whether the basis inverts. By inversion, it is meant when the futures are trading at a discount to cash. So far, so good. There is a premium, and as long as there is a premium, there is still hope that bulls might attempt a comeback. Now, for our in-house exclusive indicator, you won't find anywhere on the internet, the impetus. You've trusted this for approximately 2 years, and it has stood the test of time. Last week, even though the week was truncated due to 2 trading holidays, the impetus on both the indices has jumped. What it tells me is that there was greater force in the bull camp as compared to the bear camp. So, advantage bulls for now in the week gone by. But follow-up buying is needed to maintain the momentum and sustain up moves. Another in-house exclusive indicator you won't get elsewhere, the LWTD, the Lift Weight Thrust Drag Index. Here again, what you're seeing is the blue line represents the Nifty's percentage gain loss on a week-on-week basis, and the LWTD reading has finally come above zero after spending 3 weeks below the zero line. That tells you that even if the index was to fall on relative comparative basis with the prior week, there is expected to be improved buying support in the coming week. So this is another weight of evidence favoring the bulls, provided follow-up buying comes in. The in-house indicators done. I now come to the bond markets because this is at the crux of the trades that we put in the market in equities, commodities, and currencies, because bond markets are the fountain of money supply for the other asset classes. What you're seeing on the weekly chart is the Indian 10-year benchmark bond yield, which shed 9 basis points, which means bond prices went up. This was after the RBI Governor Shaktikanta Das kept the repo rates or interest rates steady for now. Do remember that the RBI governor has said this is not a complete full stop, it is just a comma. So if the overseas markets raise interest rates, the RBI might be compelled to raise rates at a later date, but for now it's a comma. And what it very simply means is that if the West starts to keep rates steady, or maybe as some quarters are talking about, rates might be reduced, which is what the rumor on the street is, then we could say that the rates may have peaked. And what happened to our plan of laddering? That still continues. Laddering still continues. And what we are going to do is go into a new form of investing in sovereign debt, which is gilt funds. The complete game plan is in a free Telegram channel, and if one times it right, it is fairly possible that smart playing in timing, of course, is everything. You can get up to double-digit percentage returns in gilt funds. So we are working on it, and details will be posted on our free Telegram channel. Friends, the bond market's done. I now come to the Bank Nifty, which gained 1.06% on a week-on-week basis by gaining on all 3 out of 3 trading sessions, as you can see on the daily chart on your screen. The price has comfortably closed above its month-long moving average, which also is turning upwards. The 41,840 level more or less coincides with a previous swing high. Now, why did I say last week that the market was witnessing a pullback rally and not a complete trend reversal? The reason is that for a complete trend reversal, we need any traded security to break out above a previous significant swing high and overcome all the resistance. What provides the resistance? Bulls who are trapped at the previous high level and who are waiting in the wings to get out at break-even prices will provide resistance. So if that resistance is overcome, That means the buyers have absorbed all the stocks that the bulls wanted to sell and the rally could continue. This is the underlying behavioral finance reason why we need to wait above a previous swing high breakout before saying that a bull market is here. So 41,840 still remains a critical litmus test for the bulls. Let's now see the weekly chart on your screen, a second consecutive week of gains for the bank Nifty. The index is above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook has definitely improved. Here again, the 41,840 level still remains a litmus test for the bulls to overcome. In the week before last, the bank Nifty was at number 4 on our statistical beta list of the most volatile counters intraday. It rose 2 notches to reach number 2. Now that is not really good news for an average retail trader because your challenge level has just gone up. The more volatile a counter intraday, the more chances are that you will hit your whipsaws, get stopped out only to see your targets being reached again. So let's be careful out there. Volatility is on the rise. Last week, I advocated a range between 42,100 on the upside and 39,100 on the downside, which held perfectly well. In the coming week, I estimate a range between 42,500 on the upside and 39,600 on the downside. Friends, the Bank Nifty done. I now turn my attention to the Nifty 50, which gained more than the Bank Nifty at 1.38%, rose on all 3 out of 3 trading sessions. As you can see on the daily chart on your screen, the price is above its 1 month long moving average. The average itself has turned higher, but the threshold at which we could say that the previous swing high has been overcome is above at 17,850 odd levels. Of course, for a complete trend reversal, we must go past the 18,115 level for the bulls to be completely and unmistakably back in the driver's seat. Remember the overhead supply that I talked in the segment on the Bank Nifty. Turning to the weekly chart, what you're seeing is that like the Bank Nifty, the Nifty has logged the second consecutive week of gains. But unlike the Bank Nifty, the Nifty is still below its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So it seems that the bulls are a little more comfortable on the Bank Nifty as compared to the Nifty 50 in terms of pushing prices higher in the near term. In the week before last, the Nifty was number 9 on our most volatile counters list as per statistical beta that we maintain in-house. It remained unchanged at number 9, so no change on a week-on-week basis. Last week, I advocated a range between 17,850 on the upside and 16,875 on the downside, which held perfectly well. In the coming week, I estimate ranges between 18,075 on the upside and 17,125 on the downside. I now come to the last bit of statistical analysis wherein we gauge the risk appetite of retail traders by way of which segment has contributed how much by way of percentage turnover. The daily chart on your screen shows the stock options turnover indicated by the sky blue line is down. And the stock futures turnover, which is indicated as a olive green line, military green line, is also down. So retail risk appetite is lower. I've explained to you in a separate video, which is in the description and the pinned comment below, as to what really happens when traders turn from stocks to indices or futures to options. What does it indicate as per their risk appetite signals? The other aspect is index futures turnover, indicated as a red line, is also down. So what you're seeing is that risk appetite is lower. Also, let's not forget it was a 3-day week. And we've seen earlier as to how turnover has come down sharply. Let's now see the index options turnover. This is at a period high in this 20-day look back chart. What does it tell you? It tells you that the lowest risk instrument, which also requires the lowest amount of capital to trade, saw the biggest amount of turnover. So yes, the bulls have participated in the buying last week, but they have participated in the most conservative and low risk, low capital intensive instrument, which is the index options. If at all this rally is to sustain, the turnover in index futures, and stock options must contribute a bigger percentage to the overall market turnover. We'll have to wait and watch for that. Friends, I now come to what I will do in the week ahead. Last week, I told you that I might allow the markets to rise up further because there is a possibility that the bulls will trigger a pullback rally. It happened as I expected. Am I changing my view on interest rate sensitives? No. I'm just allowing them to rise a little more and continuing with my theta decay plan of action. The criteria remains the same. I must get 21% annualized rate of return with a very acceptably low Jensen's measure and Traynor ratio reading. I indicated to you rather that I would be raising my allocation to fixed income. We did that because fresh windows of opportunity opened up on the 1st of April, like I told you. So last week, we raised our allocation to fixed income. I maintain my bullish outlook on bullion, which has been constant since 2019 for anybody who's been following me for that long. But this is for delivery-based investors. I don't advocate buying bullion in futures. I'm a believer in delivery-based investments. Divergence in oil and gas in the commodity space may continue, which is something that I told you last week itself. But theta decay in the energy space is providing decent returns both for intraday and for overnighters. Let's not forget that you have an impeding expiry in oil first and then natural gas later in the month. So theta decay might just accelerate in the coming week or 10 days. This is something that we are trying to capitalize on. As long as you have a winning formula that works, why change a winning formula? I mentioned to you in some detail as to what we are trying to do in the gilt fund scenario. If at all interest rates have peaked out, we have a backup plan ready to still bet on 100% central government sovereign guaranteed bonds in gilt funds, both for a return on investment and appreciation on that capital by way of NAV boosts that bond prices will give to these gilt funds. So we are monitoring the Hearst Expo, the expense ratio, the coupon rate cycle, the correlation coefficient between bond convexity, street level inflation, currency peg, etc. And I'll keep you posted on our free Telegram channel. Friends, now for the most popular segment of the market for the statistically inclined trader. I'll give you 5 stocks that have gained the most amount of impetus on Friday, wherein on Thursday, I beg your pardon, wherein you take small exposure, wait for large price moves, and 5 stocks that have lost the most amount of impetus on Thursday, where you take big exposure, wait for small price moves. The direction itself will be determined by your snapquote window. This is not a buy or sell recommendation, just the names. Let the snapquote window decide the direction. And this is only valid for Monday. Should you wish to be updated for the remaining part of the week, please join my free Telegram channel wherein I post all our data and research notes for free. So impetus gainers list is led by Bharat Electronics, BEL, followed by Ipca Labs, then Syngene, fourth HDFC Bank, and fifth Glenmark Pharma. Biggest impetus losers list is led by Gas Authority of India, followed by Walters, followed by India Mart, Shriram Transport Finance, and SBI Life. Friends, I hope my work on YouTube and our Telegram channel is helping you beat the market, stay ahead of the crowds, which is what our motto in life is where our trading is concerned. And it's also allowing you to learn the nuances of the market better. I would love to hear how your journey is benefiting as a trader from our work in the comment section. So do keep them coming, please. Before I say goodbye in this video, a reminder to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. And help me reach out to fellow smart traders and investors like yourselves by sharing my video with your friends and family. Thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Bye-bye.